Every week I get an email sent to me via the Dividend Report newsletter, and one of the things that it gives me is a list of dividend stocks currently at a 52-week low. And 52-week lows can be a great place to start looking for opportunities, but it doesn't necessarily mean that a stock is currently undervalued. So in this video, we're actually going to be looking at 5 dividend stocks that I believe are currently undervalued. Some of these stocks are up over 20% this year, and some are down over 20%. Each of these stocks has recently had bearish news that has created what could be an opportunity. So for each of these stocks, we're simply going to be looking at what is pushing their stock price down and then assess the valuation. And before we jump in, I want to point out there is currently a huge ticker data Black Friday sale. Ticker data allows you to pull in stock financials straight into your spreadsheet, and it works for international investors as well. It's what's allowed me to build my own portfolio trackers and stock analysis tools. Premium members can download any of my spreadsheets and will be getting access to new spreadsheets in the next couple of weeks. There's a 7-day free trial, so feel free to test it at no risk to you. Now, our first stock is Google. This is a stock up over 23% in the last year, and year to date up over 21%, and they recently announced they're going to start paying out dividends. And if we look at the recent news surrounding Google, we can see this headline: U.S. Department of Justice outlines breakup of Google in historic antitrust case. And more specifically, they're looking for Google to break off their Google Chrome browser. Now, Google Chrome is by far the world's most popular web browser, and its market share is about 66%. So obviously, like we all know, breaking off Google Chrome would be a big deal. And recently, Google Global's Affairs President Kent Walker stated Department of Justice's approach would result in unprecedented government overreach that would harm American consumers, developers, and small businesses, and jeopardize America's global economic and technological leadership at precisely the moment it's needed most. The most likely outcome is that the court will ask Google to do away with certain exclusive agreements, like its deal with Apple. They also believe that a breakup is unlikely, but that the court may ask Google to make it easier for users to access other search engines. So yes, this is a big deal, but I think this going through is actually pretty unlikely. Now, when we look at Google from a valuation perspective, to start off, if we come over to my ticker data stock screener and plug in GOOG, we can see we're talking about a company that is rapidly growing. Free cash flow in 2013 was 85 cents per share, and at the end of 2023, it was $5.50. We can see 3 years in a row now where return on invested capital has been above 20%. And their 5 and 10-year revenue CAGRs closer to 18%, and the net income CAGRs closer to around 19%. So yes, this is a rapidly growing company, no doubt. It deserves a premium valuation, right? Well, here's what's interesting about this. If we look at the price to earnings ratios of the Magnificent 7 stocks, we can see Google sitting here at a 21.3. Okay, a 21.3 price to earnings ratio. Look at the other Mag 7 stocks. They're considerably higher. Now, we could sit here all day and argue that some of these companies here listed are overvalued, but the point remains the same. Google is very undervalued compared to these other stocks. Now, you could say, well, that doesn't necessarily mean that Google is undervalued. Well, let me ask you this. If we look at the price to earnings of the S&P 500 right now, it's projected that by Q4 of next year, Q4 of 2025, the forward-looking price to earnings estimate for the S&P 500 will be 23.54, and again, Google's sitting at 21.3. So let me ask you this. Does Google deserve a higher price to earnings multiple than that of the S&P 500? I would argue that undoubtedly, yes, they do. Now let's keep moving forward. Let's jump over to my stock screener and plug in Google. And here's what I want to focus on: the historical multiple valuation. Now, what am I talking about? Well, how has Google historically traded? Have they historically traded at a lower price to earnings multiple than that of the S&P 500? So what I've done is with ticker data, I've automatically brought in the price to earnings ratio for this company over the past decade. And we can see on average over the last 10 years, their price to earnings ratio has been close to around 29.2. And we can see this charted out right here. Now, keep in mind, right now, for the trailing 12 months, it's sitting at about 22.06. So what we're seeing is for the trailing 12 months, the price to earnings ratio is close to 25% lower than the average price to earnings ratio they've traded at over the last 10 years. Again, another indicator that the company looks like they're undervalued at current prices. The only other example of this where it was lower was in 2022, when the price to earnings ratio was sitting at about 19.2. If we jump over to my reverse DCF calculator and plug in Google, again, when it comes to reverse discounted cash flow analysis, we want to see how much free cash flow growth the market is pricing into this stock. And so right now, without pricing in any free cash flow growth, the market is valuing this company at $76.87. So if we bump this up to 10%, we can see reverse DCF price per share of 154.5. If we bump it up to 11, it gets to 165. And if we put it at 11.5, we get pretty close to that current trading price. So the question we have to ask ourselves is, do we think Google will grow their free cash flow at a rate of at least 11.5% over the next decade? I'd argue it's undoubtedly going to be higher, because that's what they've done for the past decade, and I think forward-looking estimates would suggest it's going to remain higher than that as well. So for example, let's jump over to my discounted cash flow analysis, and we can see, assuming a free cash flow growth rate of 14% for this company, we'd come to an intrinsic value of $204. Again, every valuation I look at indicates that Google looks like it is currently undervalued. Our next stock that I believe is undervalued is the Hershey company, trading at $174 per share, and over the past year they're down around 8%, and if we look at them year to date, down around 5.86%. And this boils down to one main reason, and that's cocoa prices. And we're currently looking at cocoa prices over the past 6 months, and you might be thinking, okay, well, this is good. It looks like it's come down a little bit. Let's put this into a little more context. Let's zoom out to the past year. We can see it's pretty much doubled, and if we look at the past 5 years, we can see cocoa prices were pretty steady, and it's about 4 times higher than it was 3 or 4 years ago. And obviously that plays a big role in the company's margins. If we jump over to the profitability sheet, come down here, we've already plugged in Hershey. We can see over the past 10 years, they have an average gross profit ratio of about 44.98, and it's remained relatively steady throughout that period, and last year, it was sitting at about 44.7. But let's take a closer look at what's happened in the most recent quarter. Using the ticker data function, we're going to pull in the gross profit ratio for the most recent quarter. We'll select Hershey, gross profit ratio 2024 and Q3, and hit enter. And we can see a considerable decrease in the gross profit ratio, down to 41.26. So rising cocoa prices and lowering the gross profit ratio will undoubtedly play a large role in the bottom line for this company. Now, despite this, if we jump back over to my stock screener and come up here and plug in Hershey, thanks to ticker data, this will load in, and if we look at 2023 free cash flow per share, we can see it was sitting at $7.58, but if we look at it for the trailing 12 months right here, it's actually increased. Despite the decrease in margins, for the trailing 12 months, it's sitting at about $8.17, and we can see the company's trading at a pretty high free cash flow yield, sitting at about 4.69%. So that's a valuation metric. It's basically saying for every share we buy at $174, we're getting about $8.17 in free cash flow. And keep in mind, over the past decade, Hershey has been a really good dividend paying company. If we plug in HSY, we can see the starting dividend yield for this company is sitting at 3.15%. So let's put this into even more context. If we jump over to Seeking Alpha and click on dividend yield and scroll down, we can see this is the highest starting dividend yield the company has had in the last 5 years. And if we look at the past 10 years, the same remains true. Again, the highest starting dividend yield that they have had. And we can see they have a really nice history of increasing those dividends as well, with the payout ratio being sustainable. So let's look at them from a valuation perspective. I'll go ahead and jump over to my valuation spreadsheet. I've already plugged in Hershey, and we'll start with Graham's valuation. Let's go ahead and zoom in a little bit closer and take a look. We can see here, we plugged in our estimated earnings per share average based on analyst expectations, plugged in our growth rate projection, and plugged in our other variables, and we come to an intrinsic value of $141 per share, quite a bit below the current trading price of $174. But let's keep moving forward. If we look at our discounted cash flow analysis, assuming a free cash flow growth rate of around 8.5%, we come to a DCF price per share of around $183. And then if we look at our multiples valuation, let's zoom in even more to look at this. We can see how the market is valuing companies that are similar in structure to Hershey's. And we have 3 companies here, and their average price to earnings multiple is sitting at 22.1. If we applied that same average PE multiple to Hershey's, we'd come to an intrinsic value of $192.61. And then if we look at our historical valuation model, zoom out just a little bit, we can see again, the trailing 12 months price to earnings ratio is 27.5% lower than the average price to earnings ratio over the last decade. In fact, this is pretty much the lowest it's been, with the exception of 2018. Another indicator it looks like it's undervalued. And then finally, if we look at the dividend discount model, this is actually really impressive. Assuming a dividend growth rate of 6%, we come to a dividend discount model price per share of $290, which is considerably higher than that current share price. And I know that sounds a little ridiculous, but actually, if we go back over to Seeking Alpha and look at Hershey's over the past 5 years, in mid-2023, this company was trading as high as $274 per share. So if we go ahead and jump over to my valuation sheet again and look at the output tab and look at these 4 valuations averaged together, we come to an intrinsic value of $202 per share. That's about 14% higher than that current trading price. Again, this company looks to be slightly undervalued in my opinion. Our third stock is Nike, and this is one that's been hammered over the past year, down 27.4%. And if we look at them year to date, down 27.6%. And this company has been in the news a lot recently. To start out, we can see back in September, on September 19th, Nike announced they were getting rid of their current CEO to bring on veteran Elliott Hill as president and the new CEO. And then recently we saw in a Form 13F, Bill Ackman increased his Nike position by 435%. So this is a hedge fund manager making a big bet on Nike stock. Now, why is the stock down so much? And you can point to a few different things, but let's start with the most recent quarter's earnings report. We can see revenue was down 10% in the first quarter of fiscal year 2025. And to put this into perspective, if we go ahead and jump over to this sheet, let's go ahead and come over here and plug in revenue. And here's what we can see. When we look at this charted out, there is a clear growth trajectory over the past decade. But look at how much the drop-off was for Q1 2025. Revenue came in at about $11.58 billion. Well, what was it in Q1 of 2024? We can see right here, Q1 2024, it was $12.9 billion, so a considerable decrease over the past year. And this is partly due to trouble in the Asian markets, and some people argue it's also due to the brand deteriorating. But if you look at polls, if you look at what people have to say about Nike, it's clear. They're still the preferred choice for the vast majority of people. So let's go ahead and jump over to our first valuation and look at a reverse discounted cash flow analysis. I've already plugged in Nike. We can see with 0% free cash flow growth, the market is telling us Nike's worth about $56.28. Let's bump this up to around 3%. All of a sudden, we get to around $70. If we bump it up to 4%, we get to $75.31. So let's bump it up just a little bit more. At about 4.2 to 4.4%, we get really close to that current trading price. So again, the question you have to ask yourself is, do you think Nike can grow their free cash flow at a rate above 4.4%? Because if you do, then Nike is clearly undervalued, and 4.4% is not that much. I think it's a no-brainer that over the long term, even with some short-term struggles, Nike can grow their free cash flow at a rate faster than 4.4%. If we jump back over to my stock screener, again, let's go ahead and plug in Nike. And let's look at them from a historical multiple valuation once again. So let's go ahead and zoom in. What are we seeing here? Well, for the trailing 12 months, the price to earnings ratio is sitting at about 22.13. And if we look at it over the past decade, the average is close to 35. So what is this telling us? Well, historically speaking, Nike has traded at a premium valuation because of the strong brand, because of the moat. Now, the current valuation the market is giving them is about 37% lower than the average over the last 10 years. Now, I think you could argue maybe they do deserve a lower price to earnings multiple than we're seeing with the average for the last 10 years. But do they deserve a 37% lower multiple? That's an interesting conversation. Again, I'd argue it looks like they're undervalued from a historical perspective. Our fourth stock is ASML, and this has been a chaotic year for the stock, at least when it comes to the share price. If we look at the past year, yes, they're down around 2.6%, but look at the volatility. To start the year, they're trading at about $688 per share. They get all the way up to around $1,100 a share, and now they've climbed back down around $670 per share. So what's been going on with this stock? Now, to start out, actually, if we look at this earnings report, we can see they saw beats on top and bottom lines, but there was a huge sell-off after this earnings report. And to start off, we can see ASML accidentally released their earnings report a whole day early, and obviously investors were not expecting that, and this just likely added to the volatility. But here's where the big concern came in for this company. ASML's third quarter bookings fell 53% quarter over quarter to about 2.63 billion euros compared to Bloomberg's consensus estimate of about 5.39 billion. So they missed by a large amount when it came to bookings. And so no doubt this was a pretty big short-term hiccup, but I want to look at this company from a long-term perspective. A lot of people don't understand how fast the earnings for this company are getting ready to grow. For example, if we look at earnings estimates just from different analysts over the next 4 to 5 years, we're talking about 20 to 25% earnings growth year over year for the next 4 to 5 years. This is explosive growth we're talking about. And if we look at the price to earnings multiple for this company, it's currently sitting at about 33.23. And if we go ahead and jump over to our stock screener, let's come up here and plug in ASML. We can see not only are earnings projected to grow at a high rate, but they've been growing at a high rate for a while now. 2013 earnings per share, $2.78, 2023, now $19.89. So they're now trading at a free cash flow yield of about 1.08%, which seems low if you don't account for the future growth. But when you account for the fact earnings are expected to grow at over 20% for the next few years, this actually seems like a pretty good valuation. And keep in mind, if we look at the dividend breakdown, we can see not only are earnings and free cash flow growing, but they're growing the dividend at a high rate as well. Look at the 10-year dividend CAGR, 23.2%, in the 5-year, 13.7%. And so one of the things we have to keep in mind when talking about a stock, buying stocks who have their worst case scenario priced in is typically going to be far better than buying stocks that have their best case scenario priced in. And I'd argue with this huge sell-off of ASML, we could currently buy them with their worst case scenario priced in. This is a company with massive competitive advantages and is monopolistic in a lot of ways. ASML's unique value lies in its technological leadership in EUV lithography systems, where it holds 82.9% market share. This technology is essential for manufacturing advanced semiconductors, providing ASML with a significant competitive advantage. So I'd actually argue that a price to earnings of 33.23 for a company like ASML that has projected earnings growth of above 20%, that has massive competitive advantages, high levels of return on invested capital as we can see here, around 40% for the last 3 years, and is monopolistic in a lot of ways, I think this company's trading at a pretty good value. And then lastly, we have Realty Income Corporation, and the last year has been wild for them and wild for a lot of REITs in general. We can see if we look at them year to date, they're only up around 1.57%, and for quite some time they were actually in the red. But when news came out that the Fed was getting ready to start lowering interest rates, REITs started to skyrocket, and Realty Income in October got as high as close to around $65 per share. But if we look at the past month, we've actually seen a sell-off of around 5.84%, now trading at $58.32. And I think this is undoubtedly a good valuation for people looking for risk-adjusted returns and reliable dividend income on a monthly basis. To start off, look at this. Starting dividend yield sitting at about 5.5%, and if you know anything about Realty Income, they're known as the monthly dividend-paying company. They've been increasing dividends every single quarter for around 25 years, and they pay them out on a monthly basis. That's a beautiful chart right there. But let's talk about that valuation again. If we jump over to my REIT valuation spreadsheet, we'll go ahead and come up here and plug in stock ticker O. And if we come down here and look at the AFFO multiples valuation, we're looking at how the market is valuing companies that are similar in structure to Realty Income, and because they're a REIT, we're looking at the AFFO per share. That's adjusted funds from operation. And if we look at the average price to AFFO for these comparable companies, it's sitting at about 18.93, while Realty Income is sitting at 13.44. So if we applied the same average P to AFFO ratio to Realty Income, we'd come to an intrinsic value of closer to $82.15 per share. If we look at the historical price to FFO for this company, again, seeing how the market has valued them historically speaking, if we scroll down, we can see for the trailing 12 months, the price to FFO is sitting at 14.65, while the average over the last 10 years is sitting at 17.6, again an indicator that they're currently undervalued. And if we look at the dividend discount model, this is a good way to value Realty Income because those dividends are so predictable and they typically grow them at a rate of around 3.25%. So assuming a discount rate of 8.5%, we come to a dividend discount model price per share of $61.32. So if we jump over to that output tab, look at those two valuations here and average them together, we come to an intrinsic value of $71.74. And keep in mind, the historical price to FFO valuation also confirmed that the company appears to be undervalued. So again, if you're looking for something with a nice starting dividend yield, paying out reliable dividends on a monthly basis and growing those dividends, and seeing returns that are pretty good on a risk-adjusted basis, Realty Income looks like a pretty good option right now. So there you go, those are 5 stocks that I believe to currently be undervalued. Again, there's a huge Black Friday sale for ticker data right now. You can get access to any of the spreadsheets you see right here and also access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.